Is silver FOMO the trigger for the next financial crisis? Have you ever felt a tremor in the market so profound it shakes your confidence in everything you thought you knew about money? What if the quiet conversations happening in local coin shops are the canaries in the coal mine, signaling a seismic shift that Wall Street and Washington are desperately trying to ignore? We are witnessing a peculiar phenomenon, a groundswell of activity not just from seasoned investors, but from everyday people walking in off the street, driven by a palpable sense of urgency. They are converting their cash, their extras, their collectibles into something tangible, something real. This isn't just about making a profit. It's a flight to safety on a scale that hints at a deep-seated anxiety about the very foundation of our economic system. A veteran dealer has been warning of a huge spot price correction, a reckoning he now calls the Great Short. And the question we must ask is, what do these people on the front lines see that the rest of us are missing? The prevailing economic condition is one of profound and unsettling contradiction. On one hand, official narratives tell us of manageable inflation and a resilient economy. Yet the lived experience for many is a constant erosion of purchasing power. The price of everything from groceries to fuel continues its relentless climb, making a mockery of official statistics. In this environment, the very concept of saving money in a bank becomes a losing proposition. This isn't a complex theory, it's simple arithmetic. If your savings account yields a fraction of a percent, while the real cost of living rises by double digits, you are actively becoming poorer every single day. The problem is a fundamental breakdown of trust in fiat currency and the institutions that manage it. People are realizing that their dollars, their life savings, are claims on a system that seems increasingly unstable and untrustworthy, pushing them to seek an alternative. The core opportunity born from this crisis of confidence is the rediscovery of real assets. For millennia, gold and silver have served as the ultimate store of value, a financial anchor in stormy seas. Unlike currencies that can be printed into oblivion, the supply of precious metals is finite. This is not about getting rich quick, it's about wealth preservation. The people we see flocking to bullion dealers understand this on a gut level. They are opting out of a system of digital promises and paper contracts, a system where they are, as one customer astutely noted, merely unsecured creditors to a bank. They are choosing to become their own bank, holding their wealth in their own hands, insulated from the counterparty risks of a fragile and over-leveraged financial system that seems to be teetering on the brink. The catalyst for a potential market-altering event is often found not in the headlines, but in the dense jargon of regulatory frameworks. In this case, the term to understand is Basel III. This is a global, voluntary regulatory framework that outlines new capital adequacy and liquidity requirements for banks. The key disruption is how it proposes to treat physical gold. For the first time on a broad scale, allocated physical gold held by a bank could be considered a Tier 1 asset, the safest and most liquid type of capital, valued at 100% of its market price. This is a monumental shift. It places physical gold on par with cash and government bonds, implicitly acknowledging its role as a risk-free asset in a way that the existing paper-based financial system has long denied. The implications are staggering for a market built on paper derivatives. The resistance from some of the largest financial institutions in the United States to the full implementation of these new standards is, perhaps, the most telling indicator of their potential impact. The current system is built on leverage and paper contracts, particularly on exchanges like the COMEX, where the amount of paper gold and silver traded vastly exceeds the physical metal available for delivery. Basel III threatens to upend this model. If banks are required to hold more stable, Tier 1 assets like physical gold to back their activities, it could force a massive deleveraging. They would have to either acquire vast amounts of physical metal, an act that would send prices soaring, or dramatically curtail their exposure to the paper markets. This is the diametrically opposed force the dealer mentioned, the need for stability versus the structure of the current profitable, yet fragile paper-based system. This situation creates a fascinating and dangerous dynamic. The big banks that need to increase their capital reserves find themselves in a bind. The very act of them entering the market to acquire the physical gold required by the new regulations would trigger the price explosion they wish to avoid. It's a classic feedback loop. Their demand, driven by regulatory necessity, would validate the very concerns about scarcity and value that are driving retail investors into the market. It's a game of chicken, where the institutional players are trying to maintain the status quo of a highly profitable paper market, while the regulatory framework is pushing them towards a physical reality that could render that paper market obsolete. The quiet resistance to these new capital rules is a silent admission of the system's underlying fragility and its immense exposure to the physical price of gold. The tipping point will be the moment when the market's collective consciousness shifts from valuing paper promises to demanding physical delivery. This is the essence of the Great Short. It's not a short in the traditional sense of betting on a price decline, but rather a collective bet against the viability of the paper contract system itself. The historical parallel drawn to the Hunt brothers in the late 1970s is both instructive and misleading. The Hunts used leverage in the futures market to try and corner the physical silver market, an effort that ultimately failed when the exchanges changed the rules to specifically stop them. They were a single, powerful entity attempting to manipulate the market from within the system. Today's scenario is fundamentally different and far more powerful. The modern Great Short isn't being driven by a handful of billionaires. It's a decentralized global movement. It's driven by millions of individual investors, like the ones in this shop who have lost faith in the system. It's driven by central banks around the world who are repatriating their gold and buying more at a historic pace. And it's being driven by the looming regulatory reality of Basel III. The tipping point won't be a single event, but a cascade failure. It will happen when a critical mass of contract holders on an exchange like the COMEX stands for delivery of the physical metal, only to discover that the metal isn't there in the quantity promised. When that happens, the illusion of the paper market shatters and the price of the physical asset must disconnect or uncouple from the paper price. The impact of such an event would be immediate and chaotic. The price discovery mechanism for precious metals, which for decades has been dictated by the paper futures market, would cease to function. The value of gold and silver would no longer be set by traders in New York and London, but by the physical reality of supply and demand. Customers who talk about $50,000 gold might sound hyperbolic today, but in a world where the paper illusion has vanished, such figures become plausible. The aftermath would see a dramatic repricing of all assets. Those holding the physical metal would see their wealth preserved or even massively amplified, while those holding paper claims, futures contracts, unallocated accounts, ETFs that lack sufficient physical backing, could see their investments evaporate overnight. The immediate consequence is a bifurcation of the market. There would be a price for paper silver and a completely different, much higher price for physical silver. We already see hints of this in the premiums paid for physical coins and bars over the spot price. In the aftermath of a tipping point, those premiums would explode. The silver eagles a customer is buying today would be unobtainable for the paper price quoted on a screen. This new financial landscape would be one where tangible assets are king. The trust that once underpinned the global financial system would be broken, and value would flow to things that cannot be created with a keystroke. It would be a brutal lesson in the difference between wealth and the illusion of wealth. Consider the psychology at play, which is perfectly encapsulated by the term FOMO, or fear of missing out. One customer candidly admits this is why he's buying now, despite the higher prices. He waited for a dip that never came, watching the price run away from him. This is a powerful force. As prices rise, they attract more buyers, creating a self-reinforcing cycle. This isn't just greed. It's a rational response to a perception of accelerating risk and diminishing opportunity. When people see the purchasing power of their currency declining and the price of hard assets rising, the fear of being the last one holding worthless paper money becomes a primary motivator. This retail-level FOMO, when combined with the potential for institutional demand from Basel III, creates an incredibly flammable combination. The aftermath also redefines what it means to be an investor. The young 25-year-old who feels he started late but is diligently stacking represents a new generation learning old lessons. His journey highlights that this isn't about complex financial instruments or speculative trading. It's a return to basics. His experience with online auction platforms, where the excitement can lead to overspending, is a microcosm of the larger market. The fun of the auction can obscure the real purpose, which is to acquire real value. His decision to keep his core collection of old coins while seeking a fair price for his fractional pieces shows a growing sophistication. He is learning to distinguish between speculation and the foundational principle of wealth preservation, a lesson many seasoned investors have forgotten. We see this principle in action with the gentleman selling his extra Benjamin Franklin $50. He's not liquidating his entire collection. He's a long-time collector taking advantage of the higher silver price to trim his surplus holdings. This is a prudent move, demonstrating a deep understanding of market cycles. He knows the intrinsic value of what he holds, which is why he has a realistic expectation of the price, understanding the dealer needs to make a profit. His comment about the Red Book, a collector's price guide, being so far behind reality because of the silver value is incredibly insightful. It perfectly illustrates the disconnect between numismatic or collectible value and the raw monetary value of the underlying metal. In a crisis, it is the metal's value that takes precedence. The financial landscape that emerges from this shift is one that prioritizes authenticity and liquidity above all else. The dealer's hesitation over the Monero-branded gold bar is a critical lesson. Even if the gold is authentic, its unfamiliar branding and confusing packaging make it difficult to resell. The dealer isn't questioning the gold itself as much as its marketability. In a stressed market, trust and recognizability are paramount. This is why government-minted coins like gold buffaloes and silver eagles command higher premiums. They are universally recognized and trusted, making them highly liquid. The fancy packaging or grading from an obscure company, as seen with the slabbed buffalo, adds little to no value for a seasoned dealer. It's the metal that counts. This is the new reality. Value lies in what can be quickly and universally recognized as real. The long-term takeaway is a profound and perhaps uncomfortable lesson about the nature of the modern banking system. The casual conversation about being an unsecured creditor to a bank is something every single person with a savings account needs to deeply contemplate. When you deposit money in a bank, it is no longer your money. You have made a loan to the bank and they have given you an IOU. Your name on the account is simply a record of their debt to you. In a systemic crisis, as the customer noted, the FDIC insurance will not be able to cover the entire system. The promise of being made whole is a peacetime assurance. In a true financial war, the rules change and the concept of a bank holiday, where access to your own money is denied, becomes a terrifyingly real possibility. The enduring principle to be learned is the importance of diversifying not just across asset classes, but across systems of value. Relying entirely on one currency, one banking system, and one set of digital promises is an act of blind faith. The people in this coin shop are not financial radicals, they are pragmatists. They are taking a portion of their wealth and placing it outside of that system as a form of personal insurance. It's a hedge against the hubris of central planners and the fragility of a debt-based monetary system. The idea of being the bank is the ultimate expression of this principle. It means taking direct ownership of your savings and removing them from the chain of counterparty risks that defines the current financial architecture. Let's delve deeper into the mechanics of the COMEX, the primary futures and options market for trading metals like gold and silver. The dealer's reference to it taking decades for the exchange to price metals in terms of paper contracts is key. This system created a separation between the price of gold and the physical gold itself. It allowed for the creation of vast amounts of paper gold, synthetic representations that could be traded without anyone ever having to touch a real bar. This system works as long as only a tiny fraction of contract holders ever ask for the physical metal. It provides liquidity and allows for easy hedging, but it also creates a systemic vulnerability. The price is effectively set by the supply and demand for paper, not the supply and demand for the actual metal. This structure is what makes the current situation so precarious. The leverage is immense. For every ounce of physical gold or silver held in the COMEX-approved vaults, there may be dozens or even hundreds of ounces claimed by contract holders. This is the great vulnerability that the Great Short targets. The entire pricing structure is predicated on the confidence that the paper is as good as gold. But as more people, institutions, and even nations begin to question that premise, the demand for physical settlement could rise. If it rises beyond the small fraction that the exchange can handle, the system breaks. This is what is meant by a run on the COMEX, analogous to a run on a bank. It is the moment when IOU holders all show up at once to claim the real asset, exposing the fractional reserve nature of the entire enterprise. The story of the customer buying a gold buffalo and a tube of silver eagles with $5,000 offers a stark, real-world illustration of inflation and lost opportunity. The dealer's comment is chilling in its simplicity. Last year you were able to get that tube and that gold buffalo. Even 6 months ago would have been a lot cheaper. This isn't a chart on a screen, it's a tangible measure of lost purchasing power. The customer made a mistake he freely admits. He didn't buy enough when prices were lower. Now he's back paying significantly more, driven by the fear that if he waits any longer, these assets might be completely out of reach. This personal story is the story of millions, a collective awakening to the reality that waiting on the sidelines is its own form of risk. His emotional response, the feeling of "I should have bought more," is the engine of a bull market, especially in a fear-driven environment. It's a sentiment that feeds on itself. As more people feel this regret, they enter the market, pushing prices higher and creating even more regret among those who are still waiting. This psychological loop is incredibly powerful. It can override traditional financial analysis. People stop looking at price-to-earnings ratios or industrial demand forecasts. Their decisions become dominated by a primal fear of being left behind. This is when a market transitions from a gradual uptrend to a full-blown mania, and the anecdotal evidence suggests we are seeing the very early stages of this psychological shift among the general public. The discussion about different types of bullion products is also highly instructive for understanding this new landscape. The customer with the gold buffalo expresses a preference for it over the gold eagle, a matter of aesthetic taste. However, both are highly recognizable, 1-ounce government-minted coins, making them the gold standard for liquidity. The conversation about backdated silver eagles being a bargain is also key. In a market focused on raw metal value, the specific year of a common bullion coin becomes less important. An ounce of silver is an ounce of silver. For a stacker focused purely on accumulating weight, buying the lowest premium items makes the most sense. This is a market that is increasingly prioritizing substance over form, monetary value over collectible novelty. The interaction surrounding the slabbed MS-70 gold buffalo reveals another layer of market sophistication. The dealer's assessment is blunt. He is not a big fan of graded modern bullion. The plastic slab and the MS-70, grade from a lesser-known company like IGC, add little real-world value for him. He's buying the ounce of gold inside. To a collector, the first release designation and perfect grade might be appealing, but in a high-volume bullion business, these are secondary considerations that can complicate a simple transaction. The real value is the metal. This is a crucial distinction for anyone entering the market. While some graded coins have significant numismatic value, modern bullion coins are primarily a monetary asset, and paying high premiums for modern grading can often be a losing proposition when it comes time to sell. The fear of our economic future is the consistent, unifying thread running through every conversation in this shop. It's not an abstract concern. It's a concrete fear about the stability of banks, the debasement of currency, and the potential for a complete system failure. The customer who mentions keeping cash at home, just in case the bank's close, is preparing for a scenario that most people consider unthinkable. Yet history is replete with examples of bank holidays and capital controls. This level of preparedness, once considered the domain of fringe survivalists, is becoming increasingly mainstream. It reflects a growing awareness that the promises of financial security made by governments and institutions are not ironclad guarantees. This sentiment is rooted in a deeper understanding of risk. Most people perceive market risk as the chance that their stocks might go down. They perceive bank risk as nearly zero, thanks to government insurance. What they fail to understand is systemic risk, the risk that the entire system fails. In that scenario, the old rules no longer apply. Your stocks might be worthless not because the companies failed, but because the currency they are priced in has collapsed. Your bank deposit might be gone not because your specific bank was mismanaged, but because the entire banking sector has become insolvent. The customers in this shop are acting on an understanding of this deeper, more catastrophic form of risk. Precious metals are their chosen hedge against a complete failure of the financial system itself. The dealer's perspective is uniquely valuable. He sits at the nexus of supply, demand, and sentiment. He sees who is buying, who is selling, and what is motivating them. When he speaks of a great short, it is not based on theoretical models, but on the empirical evidence he sees every day. He is witnessing the erosion of confidence in real time. He sees the fear in the eyes of people who feel they've waited too long, and the prudence of long-time collectors who are strategically rebalancing. He handles the physical reality of the market, from the instantly recognizable silver eagles to the questionable Monero-branded gold. His business is a barometer of economic anxiety, and right now, that barometer is signaling a storm on the horizon. The exchange at the end about buying stocking stuffers for Christmas highlights the long-term view that many stackers take. These aren't just investments, they are becoming multi-generational assets. Giving a silver round as a gift is a way of passing on not just value, but a lesson in financial prudence. It's a tangible way to teach the next generation about the nature of real money. This act transforms a simple commodity transaction into something more profound: the preservation of family wealth and the transmission of financial wisdom. It's a move to create a store of value that exists completely outside the conventional system, a legacy that can't be inflated away or lost in a banking collapse. The brief mention of pre-1933 gold is a fascinating historical echo. The customers plan to buy a scratched called cleaned pre-33 gold double eagle after the Great Short happens is a very specific strategy. Pre-1933, U.S. gold coins carry the history of a time when gold was money. They survived the 1933 government confiscation. For many, these coins represent the ultimate safe haven asset, as they have historical and numismatic value on top of their gold content. The strategy implies a belief that after a major market dislocation, these historical assets, which are currently priced with high premiums, might become available for closer to their metal value. It's a sophisticated plan that anticipates a major repricing and a flight to the highest quality, most historically significant assets. The core lesson for anyone observing these interactions is the growing chasm between perception and reality. The mainstream financial media often portrays precious metals investors as being on the fringe. Yet the conversations here are rational, informed, and grounded in a healthy skepticism of a financial system that has shown increasing signs of stress. These are not wild speculators, they are savers looking for a safe harbor. They are people who have done their own research, read about Basel III, remember the lessons of the Hunt brothers, and understand the precarious nature of being an unsecured creditor to a fractional reserve bank. They are moving from a system of belief to a system of ownership. This is why the title of this impending correction has evolved. The Big Short was about a few individuals who saw the specific fraud in the housing market and bet against it. It was a targeted strike against a single corrupt part of the system. Calling the current situation the Great Short is far more ambitious and encompassing. It suggests a bet against the entire system of unbacked fiat currency and leveraged paper contracts. It's a belief that the endgame is not the collapse of a single market, but a fundamental revaluation of what constitutes real money and a global return to asset-based savings. It is a far larger, more profound, and more consequential event. Ultimately, the activity in this small coin shop is a microcosm of a global phenomenon. It is a quiet revolution against a monetary system that many now believe is fundamentally broken. It's a shift from abstract wealth held in digital accounts to tangible wealth held in one's hand. Whether the Great Short happens tomorrow or years from now, the underlying forces driving it, unsustainable debt, currency debasement, and a loss of institutional trust, are undeniable. The people choosing to buy a gold buffalo or a few silver eagles are not just making a financial transaction. They are casting a vote of no confidence in the current system and placing a bet on a return to a world where value is real, tangible, and enduring. The final exchange underscores the persistent nature of this market movement. Even as prices settle momentarily, the underlying pressure remains. The dealer notes the price is annoying because it had dipped more earlier, representing a missed opportunity for an even better entry point. This constant price watching, this desire to capitalize on even small dips, shows the intensity of the demand. Buyers are not being deterred by high prices. They are being energized by them, viewing any small pullback as a gift and a chance to acquire more before the next leg up. This behavior is characteristic of a powerful bull market in its early to middle stages, where every dip is bought with increasing aggression, driven by the ever-present fear of missing out on the larger move to come. The conclusion we are forced to draw is that the financial landscape is undergoing a fundamental and likely irreversible change. The principles of sound money, once dismissed as relics of a bygone era, are reasserting themselves with a vengeance. The journey from a customer cautiously selling a few extra coins to another spending a significant sum on gold and silver, all while voicing concerns about the economy's stability, paints a complete picture. It is a story of awakening. People are waking up to the risks inherent in our financial system and are taking concrete steps to protect themselves. The wisdom of the crowd is often a leading indicator, and the crowd is quietly moving its wealth into the oldest and most trusted forms of money on earth.